Banks will be reporting their most recent quarterly results next week, but most importantly, probably will be what they say about the provisions for credit losses going forward, given the negative economic impact from COVID-19. For more on this, let's now bring in John Aiken. He's the Canadian financial bank analyst over at Barclays. Analyst there. John, good to be with you today. Thanks so much for your time. This is so important, I think, for so many of our viewers to understand. So let me just kind of take it from top down. What are you expecting to hear from some of the Canadian banks next week?
Well, we definitely think that the news is going to be bad on the credit front, and this is definitely going to be a very significant headwind to their earnings. The really tricky part, though, this quarter is because of the new accounting dynamics that are being put in place, the banks are going to have to take allowances ahead of loans going bad. But somewhat ironically, this quarter, we actually don't expect the loans to bad loans to spike because of all of the deferrals that have been going through the system, both on the personal side as well as on the business lending side. We really don't even know which loans are actually bad. However, because the economic outlook has changed so dramatically since the end of the first quarter, which was January 31, that they're going to be forced to put up some provisions against loans that are going to be bad. It's going to take several quarters, though, to figure out which ones are bad and exactly how much of an impact this is going to have on the bank's balance sheet.
So that is that's quite a complicated quarter then that we probably will be seeing for the Canadian banks next week, because there's really a timing issue going on here. But what do you think then?
Absolutely.
I mean, what do you think then is going to be the right communication strategy for these bank CEOs to, be a fiduciary, to be responsible to the shareholders, but at the same time, not to necessarily spook the market? Not that that's their job, but again, that's a very difficult message to manage. So what do you want to hear from them specifically then?
Oh, absolutely. They're walking a very fine line in terms of trying to put confidence into the market that these allowances are going to be sufficient for the bulk of the losses that they're going to take on their loan portfolio, and yet not take so much that they actually completely impair their profitability this quarter. And if you look at what the U.S. banks reported, and their quarter end was a month ahead of the Canadian banks, what you saw was very strong provisions against bad loans, but not so much that you actually saw earnings disappear or even turn negative. The problem the Canadian banks face, though, is that we're an extra month into the impact of the shutdown. Presumably, their economic outlook is going to be a little more dampened than what the U.S. banks saw. And so what you really need to do is give confidence to investors, to the market, and says, hey, we're doing the prudent measures, we're making sure that we've locked everything down, and we want to be able to make sure that our operations outside of this credit impact are untouched, and we're trying to do business as best as we can under these challenging times.
And what do you think the rest of the business looks like at some of these Canadian banks? Because, when you talk about the allowances and the fact that we probably won't see some of the bad loans this quarter reported because of the programs, some of the great programs that the government has provided to companies, that the hope is that those packages bridge the gap here.
Yeah, absolutely, and that is the hope. That is obviously what the policy the government is putting in place is trying to ensue. When you're looking at the rest of the operations, so the banks, though, when you look at what should be happening is lending is definitely going to be slowing down, with the exception that the emergency business loans that the government is providing is actually being run through the banks. So we're actually expecting to see fairly reasonably strong growth within their business lending book. However, the impact that that's going to have on their margins is going to lead to compression because there's no interest being charged on that. So nothing is going to be flowing through their income statement in that regard, as well as the drastic cuts that the Bank of Canada has put in place. We're likely going to see some measure of margin compression in the quarter as the banks are earning less on the loans that actually are active. But because of the way that the Canadian bank loan book are structured, we're expecting that impact to be felt over not just this quarter, but a couple trailing quarters going forward. But then if you look at some of the other operations that the banks have, capital markets should actually be a bit of a salvation, definitely not offsetting the impact of credit, but you're going to see very strong trading numbers because of the volatility that's ticked up. The banks have benefited from that in terms of transacting for clients. You're going to see the benefit of a lot of debt issuances on behalf of the customers, particularly the investment grade. But unfortunately, you're probably going to see a drop down in advisory because things like M&A are very difficult to complete in this environment. And finally, the wealth management operations, well, assets under management are going to take a bit of a hit because of the downward spiral the equity market saw through April. Honestly, the bank's books are not nearly as focused on equities as some other asset managers are. They're actually higher proportion of fixed income, and we actually could see not a lift in AUM, but definitely nowhere near as bad an impact on wealth management as we may see in some of the other operations.
So, John, a bit of a mixed quarter, a mixed picture, really, because to your point on the capital markets front, which certainly helped those U.S. banks as well, got a little bit of a lift in definitely a positive area of the market. But the question is, when you take a look at the Canadian banks and they're down anywhere from, 25, 30% or so, how much of the negative news surrounding provision for credit losses do you think is accurately baked into the current stock prices?
We actually think that the market has been quite rational in terms of the approach that they're taking on the valuation of the banks. We do think that a pretty bearish scenario is already being priced in terms of the credit outlook. However, if we are heading into a deep and prolonged recession, obviously the losses will be much higher than what's currently priced in, and obviously the valuations are not truly reflecting that. But the investors are looking at the bank saying, you know what, there's going to be a headwind to earnings in 2020, maybe possibly into 2021, but as long as the economy is able to repair itself, the bank should be able to salvage themselves, and we're going to see growth going forward. But the drop that we're seeing in share price is basically trying to handicap how long that is going to take. We're reasonably comfortable with the valuation of the Canadian banks at this stage in the game, but keep in mind that we still have not seen any hard economic data as to what the impact is, and quite frankly, where we're headed, no one truly knows, and that this is the push-pull that we're seeing in the marketplace every day.
Yeah, every day, John. Question, with respect to the Canadian banks not cutting dividends during the great financial crisis, it was a financial crisis and they didn't cut dividends. Is it going to be different this time, or can our viewers still count on their great Canadian banks paying them dividends?
From where we sit today, we do not expect to have any of the banks be forced to cut the dividend. In terms of our estimations, we're looking at roughly around $14 billion being taken for credit loss provisions over the course of the next year and a half, 2 years. And even if that were all taken in the quarter today, you would not see a significant erosion in the capital that would force the banks to try to shore it up through capital measures. And as you point out, during the great financial crisis, the last thing that Canadian banks wanted to do was cut their dividend. We think the philosophy has not changed. And if you look at what they did in 2008, they actually were actively raising common equity while still not cutting the dividends, because they realized how important that is, not just to their own valuation, but to their shareholders and investors that quite frankly, today need income.
Absolutely. All right, John, great to catch up with you on that. Thanks for the preview. Week we'll be watching closely. That is John Aiken. He's the Canadian financial bank analyst over at Barclays.